Now, civil society organizations have faulted the government's decision to issue a fresh Eurobond, saying that they will place the country pressure the country's already high public debt.
That's right. Well, the Okoa Uchumi working group has accused the government of flouting the rules of the Public Finance Management Act by issuing another Eurobond to raise cash to finance a buyback of the 10-year $2 billion Eurobond. And as Mary Muoki reports, the group says although the borrowing saved the country from being listed as a defaulter, it is a public debt that Kenyans can no longer afford to shoulder.
About 2 weeks after Kenya tapped the international bond market for another Eurobond to raise cash to finance a buyback of the 10-year $2 billion, opinion is divided on the wisdom of that decision. The Okoa Uchumi group has hit out at the government for floating the Eurobond, arguing that it was a mere deferment of a debt burden to a future date.
We citizens and institutions working in Kenya are shocked that the government is celebrating by buying back the Eurobond with another Eurobond at a higher interest rate of 10.7%. The economic backdrop against which this decision is made raises questions about prudence. The move to issue a new Eurobond appears to be a short-term fix to a more profound economic challenge.
Being a dollar-dominated bond, there are higher chances of global economic shock awaiting in the form of increased interest rate and continuous depreciation in the local currency, thus making the debt to be more expensive to repay. We are also perturbed that Parliament and the Executive find it's okay to repay a Eurobond, whose acceptation and utility have been questioned by the independent fiscal institutions.
The group has accused the Bretton Woods institutions, the World Bank and the International Monetary Fund for exerting pressure on Kenya to continue borrowing expensive loans that come with stringent conditions. The civil rights group says IMF's fiscal consolidation program for Kenya, which is ostensibly designed to help Kenya address its public debt challenges, is hurting the Kenyan economy.
Also paradoxical that the government of Kenya is only concerned with the return of the private investors in the refinancing and repayment of the bond, rather than looking at the bigger picture of the overall burden that is compounded by the price of
equity as per our constitution.
The new Eurobond has helped to restore investor confidence over the possibility of the country defaulting on the repayment of the $2 billion Eurobond that is maturing in June. The new loan has a weighted average life of 7 years and is expected to mature in 2031. Mary Muoki, Citizen TV.